So good afternoon, everyone. Today we are going to explore a critical intersection in the modern financial landscape, and that is how the innovative power of fintech, when combined with the robust cybersecurity infrastructure, can truly drive financial inclusion globally. It is about building trust in a rapidly digitizing world. So this is what our conversation is going to revolve around today. We have the agenda for today's session, and there are 5 of them there, as you can see. So our journey today will basically cover 5 key areas. First, we'll define the foundational concepts of fintech, financial inclusion, and cybersecurity. Then, we'll examine fintech's incredible potential as an engine for inclusion. And then next, and the third bullet point, we'll pivot straight into understanding why cybersecurity isn't just an add-on, but an indispensable enabler of trust. This will lead us nicely into discussing a crucial synergy, which is how to design secure products for inclusive finance. And then finally, we'll conclude with our key takeaways, and then perhaps open the floor for questions if there are any. So that is just a summary of what the conversation or how the discussion today would proceed. So moving on now, we are going to define our key concepts, the core concept of today's discussion. To ensure that we are all on the same page, we'll start by establishing clear definitions for our 3 core concepts. As you know, the topic today is synergizing cybersecurity and fintech in promoting financial inclusion. So from that topic of the discussion, you can see or deduce that the key words here is financial technology, which is fintech for short. We have financial inclusion, and then cyber security. So we would understand these key concepts because they are crucial for us to appreciate their intertwined relationship and then get the overall gist of today's session. So without further ado, we'll move straight into the very first, which is financial technology, or otherwise known as fintech for short. So fintech, simply put, is essentially the application of technology to deliver financial services and products in new and innovative ways. We can think about it as revolutionizing or maybe disrupting how people or we interact with money. And it encompasses everything from online banking apps to complex blockchain systems. You might want to cast your mind back to how life might have been just before the advent of banks as we know them today. People have the need to protect, preserve, and even save their funds. Some keep their money in their homes, some keep it under the bed, some import, some can dig ground to store their assets because they want it to stay for them as long as possible and to also secure their future. Then with that, gradually, at some point, money was actually saved in temples. That was where the original form of banking actually began. People saw the need to save their money in temples in times of Romans, the Greek times and all that. They went to temple because they feel that the temple, being a place of worship, is going to help them preserve their funds, and the likelihood of theft or losing those assets is minimal, given the sanctity that such buildings hold. And even the temple workers then and were merchants. They were the ones carrying out the day-to-day transactions like we know them today, savings, lending, and so on and so forth. We know about the trade by beta, and how people were trying to at least manage the assets. And then moving on and on, we began to see the banks as we know them today. People were happy because they think it's better off, it's more efficient, is faster at the time as they know it then. But again, it comes with its own gaps because there is the need to save costs, time people waste in terms of having to stand on queues, the long and laborious paperwork people need to go through, and all of the challenges that goes along with banking as we know them, or traditional banking. But then as internet came along, mobile phones came up, further technology came in. This was the incubator for driving fintech as we know it today. So fintech had to leverage on internet, mobile phones, and then with that pathway created, it was like a world of opportunity that was open for people to exploit and bring in more innovative, transformative, and disruptive ways of doing things. And that is basically the core of fintech. In the world of fintech, we have some basic core jargons, which we know today. There are many of them, to be fair, but we cannot really explore all of them within just this short session. But we just limit it to 3 of them. One of them is mobile money. Mobile money has proven to be a game changer when it comes to how people interact with funds, especially in emerging markets, developing countries, most part of Africa, some part of Asia, and so on and so forth. This allows users to store, send, and receive money via the mobile phones without needing a traditional bank account. We have examples like the M-Pesa in Kenya, which is a clear example. That product really deepened financial inclusion in Kenya. I think almost about 90%, because people from all strata of life were able to at least have some meaningful interaction with funds, do savings, do insurance, and so on and so forth. If you even come to Nigeria, for example, we have things like the OPay, we have things like Momo, and so on. These are organizations that also leverage with even telecom companies. Like Momo is linked strongly to MTN. We have others too in other parts of the world. OPay, like people can easily, in fact, your mobile number becomes your account number, as it were. So it's easy to remember. You don't have to go to bank and do a lot of, too much paperwork and all that. People can easily save money, do transactions, receive money as well, pay bills, and so on and so forth, without much hassles and at lesser cost. And the beauty of it is that it's applicable even to phones. It doesn't have to be smartphones. It could be as low as feature phones, those very cheaper ones that people in lower income areas or rural communities can easily afford. And that is the very essence of we talking about financial inclusion and how fintech is also supporting this objective. So that is mobile money. We'll talk about also digital lending. This is also a key, because when we discuss small, medium enterprises, that's the SME businesses, oftentimes the key challenge they face is in accessing finance to run the businesses. And digital lending has to do with providing loans quickly through digital platforms, often leveraging what we call alternative data sources to access creditworthiness for those without traditional credit history. So we know today that if you want to go to a bank to get funds for your business, you should be able to provide some form of documentation. There should be some history that the bank should be able to leverage on to be able to make a decision as to whether you are creditworthy or not. They might ask for your bank statement. They might ask for your invoices and purchases for, as you used to run the business. They might ask for your records, sales records. They can ask for even collateral, as the case may be. These are all things. And if you have been used to the banking system, you might have what they call a credit profile. So the bank might refer to what we know as credit bureau agencies, to see how the previous loans you've taken in the past, how you've paid them, if you have been defaulting or not, and so on and so forth, and for how long you've taken them for. So that will give them an idea of your credit worthiness, and if they can give you funds and how much they're going to give you and how long they're going to give you, and so on and so forth. But I'll bring it down to those who are in the remote areas, who are digitally excluded, who have not even had any much interactions with bank, as it were. These ones don't even have nothing for the bank to work on, as we call it information asymmetry. Basically, they are completely like a black hole, nothing to know. So based on that, the risk profile of these low income earners, these financially excluded ones, is assumed or deemed to be high. And so the banks are not willing to support them. And when they don't support them, what happens? They can't fund their businesses because they need funds to run the businesses. They can't fund it. When they run out of funds, they either close up. They close up, and then it causes more poverty, more hardship for them, because they can't support their families as they would be able to do so. But for those who are able to access funds, they get more money from the banks, and you see the gap keep widening, because the rich keep getting richer while the poor kind of keep getting poorer. But with alternative data finance or alternative data sources, fintech is able to leverage other financial activities that these ones do, in as much as they are not in the financial mainstream. Things like utility bills, how you pay your rent, how you pay your mobile data, even your use of data on the internet, and things like that, things you purchase, and so on and so forth. Even your income, how regular is the income, and so on. So these are alternative sources that fintech uses to create a profile, a risk profile for these ones, and then make a decision as to, okay, let's even give them a little funds. Once that fund is given to these excluded ones, at least they are now in the financial system, and gradually, no matter how small, as they pay, they begin to build their profile or credit history, and then it gives them more pathway opportunity to get more funds. Then we talk about RegTech, which is a short word for regulatory technology. So this is a technology that is specifically designed to help financial institutions comply with regulatory requirements more efficiently, making compliance less burdensome and more accurate. So that is what that is all about. It's about helping banks. You mean some banks can put in some AI or machine learning systems in place in their compliance processes such that it helps them trigger certain touch points, or when there are certain breaches, it helps trigger it to ensure that they remain compliant, because there are bodies who also oversee how these financial institutions operate, including fintech. In Nigeria, we talk about Central Bank of Nigeria. In the UK, for example, we talk about the Financial Conduct Authority, and every other country have their regulatory body. So fintech also has an arm that helps to ensure that these financial institutions stay compliant and offer responsible financial services. Moving on from there, we go to the next concept, which is financial inclusion. So financial inclusion is not just about having a bank account. It's about ensuring that everyone has access to useful, affordable, and responsible financial products and services that truly meet their needs. And this includes transactions like payments, savings, credit, and insurance. Again, the key word is not just having a bank account, but that people have useful, that the service offered by the financial institution is useful. By useful, meaning that it meets the need of these people. It's relevant to their situation. It's not just a one-size-fits-all kind of product. So it's useful. Secondly, it's affordable. Of course, we're talking about those who are financially excluded, most of which are within the lower end of the financial pyramid or income pyramid. So it means that for the product to really meet their need, it has to be at least affordable for them to be able to use. If it's expensive, then it's not for them. So that is key in the designing of that product to meet or to achieve financial inclusion aims. And then thirdly, it has to be responsible. Responsible here implies that it should be tailored in a way as not to exploit the vulnerabilities of these financially excluded people. In other words, there should be no black holes in terms of information being shared to them. If you say something is going to do this, let it do it, and it should be explicit and expressly stated. There should not be conditions that are tied at the back end that they will not be able to see, either because they're not educationally sound as they should be, or financially literate, that's the right word, or digitally aware of these things. Or you shouldn't leave room for assumptions. Communications, adverts, and how the product is designed shouldn't leave room for assumptions for these ones. It should be black and white in simple terms, so that when they make a decision to take a product, either loan or savings or whatever it is, they are taking it as it is, and that is what they are getting. Not at the end of the day, they take it on the assumption that, oh, this is what I'm getting. At the end of the day, charges start coming in here and there, and you'll be like, after all, you signed up yourself, but you know as a bank or institution that you did not make it as clear as possible for them, considering their situation. So it has to be done responsibly. Of course, this service should also be sustainable, meaning that it should be sustainable over time, not just something you do for a moment, just to bring them into the financial mainstream. And then when they're in, you now start hitting them with the charges, you now start treating them anyway, or you start thinking, oh, these ones, they're not really giving us the kind of profit we want, because that's one thing that has to do with inclusion. It has to do with that passion to really want to bring them in. They may not give you the kind of profit you want because of you having to cut down a lot of cost and bring down things to really tailor it to their needs. So it has to be sustainable over time, and while being also profitable to the business, of course. So these two has to be balanced. We call that the double bottom line, basically. So that is what we should expect when it comes to financial inclusion products designed in this with this in mind. In financial inclusion, there are two key concepts we talk about, which is the unbanked. These are the ones who have no access to any form of financial services at all. And then we have the underbanked. These ones have some form of access, but they still rely on expensive informal methods to still do certain bits and bobs about when it comes to their financial lifestyle. So the overall or the overarching aim of fintech or financial inclusion rather is to bridge this gap, ensuring that financial services is not just a privilege, but a right for every single person. So this is the main trust. So we're going to talk a little bit more as we proceed on this one, but just know that we have the unbanked, those who don't have any access at all to formal banking system, and we also have the underbanked who have a bit, but still struggle with other forms of financial interaction because of maybe their profile, which we'll probably delve into more later. So the third concept, the third core concept here is cybersecurity. Sorry. So cybersecurity, as we can see, is in simple terms the practice of protecting digital systems, networks, programs, data from digital attacks, theft, or damage. So at the very core of cybersecurity is what we know as the CIA triad. The CIA triad simply refers to confidentiality, which is the C, integrity, which is the I, and then availability, which is the A. So the C refers to confidentiality, which simply has to do with keeping sensitive information private. Integrity refers to ensuring that data is accurate and has not been tampered with. And then availability simply talks about guaranteeing that systems and data are accessible when needed at every point in time. So that is what we simply call the CIA triad. And this forms the core principle for the operation of cybersecurity. Again, like the first two core concepts we defined, there are some key jargons which we might just highlight for the purpose of this presentation. We are not exhausting it, just to be clear. There are lots of them, but for the purpose of this presentation, we talk about data encryption as one of those key jargons. Data encryption has to simply refers to scrambling information or data so that only authorized persons can read it. So it's about messing up the data from the point where it leaves. The data is scrambled, is messed up. It doesn't look as it's going through that platform or pathway or technological conduit, as it were, is all scrambled up until it gets to the intended user. Then it all comes together and makes sense to that person. So that way, even if it's intercepted, nobody can really make sense out of it. Some of us, I believe most of us in the audience have what we use WhatsApp. So if you're going to send a message, for example, to, let's say, a first-time person, oftentimes you see a little message at the top, of your message wall there that says messages are end-to-end encrypted. Yeah, messages are end-to-end encrypted. You see that on WhatsApp most times. If you take notes, you see that. So it's just telling you the same thing I've just said, meaning that the moment you type a message, say hello, good morning, that message leaving your phone, at the point it leaves your phone, it's all scrambled, it's all messed up. As it passes through that technological pathway, it doesn't make sense. But once it gets to the intended user, which is the mobile number stored on your phone and registered by WhatsApp, what happens? It all comes together and the person can clearly see that you just send them hello, good morning. So that is what applies even in this context, in the sense of cybersecurity and, of course, fintech. Then the next one is about authentication. Authentication is about verifying who you say you are, whether it is with a password, a fingerprint, a face scan, or whatever. So this is where we talk about you putting your PIN, your password. Maybe you want to log into your mobile app, you have to verify. Some use things like two-factor authentication, where even after putting in your PIN or password, as the case may be, you get another message from either an OTP, a one-time password, or you get, we'll have some authenticator apps, maybe like the Microsoft Authenticator app, where it tells you to go and enter maybe some six-digit number, and then to complete your authentication. So this is part of cybersecurity too. And then we have what they call the zero trust architecture. So the zero trust architecture simply works or means verifying everything and trusting nothing. So it is a modern security feature or model that says never trust, always verify. Never trust, always verify. So it assumes that threats can come from anywhere, inside or outside the network, and requires constant verification. So a little example could be, maybe you're trying to, let's say you work in a building, let's say you work in a bank, for example, or whatever you work. For you to get into your building, to get into your workplace, there might be a security light at the entrance, who maybe upon sighting you can, okay, allow you pass. Or maybe you can just flash your ID card and they say, okay, it's one of us, they let you in. Or perhaps, let's say you don't even have a security, or let's say you won't have and the security lets you in, but you might need to probably tap your card. Maybe the card has some security features where you tap for the barriers to open for you to move in. If you don't have the ID card, you don't go in. You tap that card, you're in. Now you're in the building. The moment you're in the building, traditional model, if it's not zero trust architecture now, we're just talking about what we know now. They assume that once you are in, you are trusted. You are one of us. So you can go into the accounting department if you want. You can go into the IT room if you want. You can go into where you have the data room. Wherever it is in that building, once you are in, you're one of us, you're trusted. Access any resource you want to access. But when it comes to zero trust architecture, it doesn't trust. It's always wanting to verify. So if you look at that building as the fintech, the building you're entering, like where you work, as fintech, and the infrastructure, the payment infrastructure that you have to go through to complete anything, that is the building. And then if you look at the resources that that young man in the building is going into, maybe the accounting department, the data room, the IT room, wherever he wants to go in that building, those resources, consider them to be, say, the funds in the account, transactions you're making, bill payments, and so on and so forth. So if you log into a mobile app, for example, you put in your password, right? In some cases, you might be asked to get a two-factor authentication from a different app to verify. Now you are in. So that's like you tap your card into the building. Now you're in the app, right? Now, once you're in the app, if you want to say make a transaction now, mind you, once you're in the app, the trust resets. It goes to zero. You are in, that's fine. You've passed the first point of entry. Now you want to make a transaction of say 100,000 naira, or let's say something around 50 pounds, if you like. What happens? Once you put in the details and all that, I ask you to put your PIN. So it doesn't assume that because you've already logged into the app, so for that, you can just do any transaction you want to do whatever you want to do, that's on you. No, it asks for a PIN, which is different from the same password you used to log into the app. So it asks you to authorize. Once you authorize, okay, the payment goes through, that's fine. Let's say you want to make another payment of, say, 3 million naira now. This is a larger payment, and there's a limit for what you can do maybe for that day. What happens? It asks you first to put that PIN you entered when you paid the 100,000 out, and now it might ask you for an extra layer of authority. It has reset the previous one you did. It's not going to assume that because you've done 100,000 before, so just be sending the money. No. It's going to ask you for another authorization. It could be another two-factor authorization, or it could be asking for your fingerprint or your face ID, right? It could just be anything, but it's going to ask for further verification. Some banks will ask for token, like a little extra, device where you just go and type up some numbers. So if you don't have that, it means you can complete that transaction. So this is what we're talking about the zero trust architecture. It doesn't assume that because you've been allowed into the app, then you can just go anywhere you want to go, do what you want to do. Even like OPay, for example, you have things like the night guard in OPay, if you remember. So once you can set it like, say, okay, from 11 p.m. to 3 a.m. is my most vulnerable period. Any transaction that comes from this time of the day, please request maybe a face ID or a fingerprint or extra layer of authentication, something like that. And then it can happen. Somebody can pick your phone anywhere, and then, maybe around 2 a.m. in the morning, they want to make transfer, even if it's 1 naira or a pound, to ask for that because you've set those features. So that's what we mean by zero trust architecture. Simply put, never trust, always verify. So if we move on now to the next slide, we have finished the first part. So now that we've defined our key terms, let's now delve into why fintech is such a powerful engine for driving financial inclusion. So that takes us to the next slide. I hope we can see this. Yeah. So fintech addresses many of the barriers that traditionally excluded vast populations from financial services, like I've mentioned before. So we're going to look at some key strengths of fintech in resolving or addressing or promoting inclusion, if you like. The first one is lower cost. So fintech companies typically have lower operational overheads compared to traditional banks. So it means that they can offer services at significantly reduced fees. You can think about the high cost, for example, of maintaining physical branches. So when a bank, normal banks we know today want to operate, of course, they have to get branches. Either they lease or they buy the property. That is huge cost already. And then they buy it or they lease it for some long years. And then not just that, they have to put in some, asset into it, computers, generator sets, put a lot of things, to make sure that the place is fit for purpose in terms for banking transaction. So these are what we talk about when we talk of overhead costs. They also have to employ people, because for every branch they open, they need manpower to man these places, attend to customers. So that is more cost in terms of number of employees they need to pay and all. So all of these contributes to the huge cost that might gradually build up if you are using the normal traditional banking systems to run some financial transactions. But when it comes to fintech can just probably get, like digital banks, like we know them today, can just get a building, and that is where they all have all their hub. The rest of the things are done by technology. They invest heavily in technology, and this technology, it doesn't, you don't have to buy new ones all the time. Once you set it up, can only improve the system as time goes on, but it's there, it's already serving. So it cuts down the need for extra manpower, buying of extra computers, assets, fixing and fitting a full building, and then the cost of buying too many branches at the same time. So all of these costs are cut off, and then they are channeled into actually tailoring product or designing products that are tailored to meet the needs of these individuals that are financially excluded. And then what happens? It helps them bring down the cost of serving these ones in the long run. So that is where we talk about lower cost. So in sub-Saharan Africa, for example, like I mentioned at the onset of this talk, emerging markets, really, mobile money transfers are often much cheaper than traditional bank wires, and they make remittances and other everyday payments affordable even for low-income earners. So this is one way that fintech is actually helping to drive financial inclusion by offering cheaper and more cost-effective services. The next one is increased reach and coverage. So the ubiquity, or will I say the massive expansion of mobile phones has allowed fintech to bypass the need for physical branches today. So services can now reach remote and far-flung corners of the earth, rural communities and populations previously underserved. They can get access to financial services. I mentioned M-Pesa before, which has an extensive network of agents that act as cash in and cash out points. Essentially, they bring banking services to the doorsteps of these villagers. I remember when I was working back in the days with Finca. Finca is an international microfinance bank, and the organization is in I think when I used to work then, over about 18 to 20 countries across the world, mainly in emerging markets, low income countries and all that. The drive for inclusion is very massive, and whilst working with them in Nigeria back then, we have a product then which we launched, which we call the Finger Express. So I personally took it upon myself to go into a community. It's known as Umagwo in Ohaji, my local government area. So there are lots of farmers here who are mostly unbanked, with very few being underbanked. So they are just farmers. They are into palm oil production, palm oil cracking, and all of that. So that's what they do. They don't have part. The nearest bank to them is about an hour, an hour bus. You take a bus for 1 hour. So it's a huge gap there. So when we launched this, and I noticed the huge market there, I started, transacting with them, and I introduced them to the bank. The bank was happy, and with time, they launched what we call the Finger Express. So that Finger Express means they have to get agents around that community, not just in Umago, really, other parts of areas where we serve within that Owerri community. But I'm just specific about Umago because it's a very remote place, and it's relevant to the discussion. So those POS were distributed to this agent, and those agents serve like the banks. So these people don't need to travel 1 hour, 2 hours down to the branches to take funds. In fact, they were not even giving credit before. I was the one that championed the cause for them to have access to credit by profiling them and making a strong case and proposal before the bank, and they had to take it up, and it became profitable in the end. But the point I'm making here is the Finger Express product leverages on agents. So one agent sign up, they give them the POS, customers can go, because they have an account, they can use their fingerprint. So if they want to make a payment, they just put their fingerprint and the payment is in. They can also pay cash into their account. It goes straight into their account in the bank there, and everything they need to do, they can check their balance and all. So this is about increased reach and coverage. We also have things like the POS, for example, those telecoms company that works with banks, by providing financial services. In Nigeria, for example, there are POS points scattered all over the place. You don't really have to go too far to get banked. And this is all enabled by the power of fintech. It's promoting financial inclusion, and it's even creating jobs for people who don't even have source of income before then. So that's what we mean by increased reach and coverage enabled by fintech as opposed to the traditional brick and mortar banks. So we talk about the next one, which is tailored data-driven product. So fintech, like I hinted earlier, use data analytics, right, to understand customers' behavior and needs, enabling them to create highly customized financial products. So this could be micro insurance policies, small short-term loans, that align with irregular income patterns of these financially excluded individuals. For example, if we go to maybe in Europe, say the UK, we have digital lenders that use alternative data like utility payments to access creditworthiness for migrants or young professionals who lack traditional credit history, and that's kind of open access to credit for them. So, like I hinted earlier, financial inclusion is not just peculiar to emerging market. There are, even in developed countries, there are people who are unbanked and underbanked. For example, in the United Kingdom here, there are people who, if you check statistics, I think about 1.546 million people thereabout are financially excluded in the United Kingdom. So one would be like, wow, really? Are there people like that? There are. So it is a global problem. It's not just only for emerging market and all. People are really going through these struggles on a day-to-day basis. And like I hinted earlier at the beginning of my, when I was discussing financial inclusion, somebody can easily move from being even financially included to being, in a sense, financially excluded by being underbanked. So, say for example, myself here now, let's say back in Nigeria, yes, I'm literate, I'm financially aware, I have bank accounts, I understand how to manage my finances and all. So I am not financially excluded. But upon moving to the United Kingdom, for example, you can easily move from being that financially included to being underbanked, as it were, because there are some services that you won't be able to access, especially when it comes to credit, because you have a thin credit file, as they call it, a thin credit file. You don't have a credit history that they can use to lend, so you can't go and borrow money easily from the traditional banks and they give it to you. And let's say you want to get a mortgage for your property, you want to buy a property or mortgage, you can't. Most times they expect you to live in the country for say 3 to 5 years to get certain loans or mortgages, as it were. So in that sense, you see that even though you are learned, you and everything, you are digitally aware, you are underbanked at that point in time. As long as you're not able to access certain financial services for whatever reason, you are underbanked in that sense. But with fintech now, you can easily, at least there is a chance that they use that alternative data, which I mentioned earlier. Because I'm here in the UK, for example, I pay my bills. Of course, you can't do without paying bills. You pay rent, you pay light bills, you pay water bills, you pay internet bills, right? You pay your rent as well, and you have income coming in, regularly. All of these are used to build a profile, a picture for you. That is what fintech does, that most traditional banks may not be willing to do or take that kind of risk. So that gives a leeway for you to at least get some credit. So this is how most persons who are migrants, in most of these developed or European countries, they survive because of this ability. And with the advent of open banking, even merchants, commercial service providers can tap into that. They share information, and then they begin to create that data points for you, and then see how to advance some products or tailor them to meet certain customers. So that's what we're talking about when we talk of how fintech is promoting inclusion. And then we'll talk about efficiency and convenience. Digital platforms offer speed and convenience. Account opening can take minutes, not days, and transactions are often very instant. So digital-only banks in the UK, for example, we have Revolut, we have Monzo, attract tech-savvy users, and those who are frustrated with the slow paper-based way of doing things, by traditional banks, can at least get rapid response and onboarding, when they want to, get this account. So like when I opened my first account in the UK, it was Monzo I used. I didn't need to go to any bank, but I went to one of the banks then, Barclays, and so, sorry, it wasn't my Lloyds. I went to Lloyds and it was like a back and forth all the time. You keep telling me not working, not working. I tried this, I tried that, I used it. It was hell. I just went to Monzo, straight up, take your picture, they take your finger, your face print, you provide your details, you snap your ID card and all of that, and they use that. You create an account. Before you know it, in 7 days, you get your ATM card by post, and then you're good to go. So this is what we're talking about efficiency that fintech brings to promote financial inclusion. We can now move on now. So now, having discussed the benefits of fintech in promoting financial inclusion, we want to also understand that there are crucial weaknesses or inherent risk and vulnerability that comes with fintech. Fintech's reliance on digital channels create a large attack surface. So what is the result of this? It leads to a rise in digital fraud, data breaches, and scam, especially for the less digitally literate users. And that is expected. So because they leverage on tech and the internet, of course, there is room for fraud to happen. There is room, of course, we said they use data so much, alternative data to tailor product and all that. So there is a chance that data can also be breached. And when this happens, it's a big problem. And then scams, especially for those who don't know how this tech thing work, and they are excluded and they are not that aware. So these are the issues. So however, fintech's greatest strength is also its weaknesses, like I mentioned. Its reliance on digital channel creates enormous attack surface. So it means there are more points for cyber criminals to exploit. And this means that while fintech makes financial services more accessible, it also exposes users to new and evolving digital threats. Now, the result is that there's a worrying rise in fraud, breaches, and all, like I hinted. And those who are new to digital finance may lack that literacy to be able to cope with this. So if users lose trust due to this risk, they will simply revert to using cash, and that will undermine any progress made by fintech in promoting financial inclusion. So that is a key area that needs to be looked into. Finance is about trust. And once that trust is not there, then there's a problem. You would agree with me that even with all the advent of fintech today, there are people who sit there that they still prefer to go to traditional banks where they are seeing the branches face to face. Anything that happens, they can just walk into the bank and get their issue instead of hoping on one digital bank that they've never met before. It's only by phone call or by email that they do things. If their money is gone, it's gone. They don't know where to go and look for it. So it means that trust is a critical factor if fintech is actually going to thrive and remain sustainable in its effort in driving financial inclusion. So, and that brings us nicely into the next bit of our conversation, the third aspect of our discussion today, which is cybersecurity. So the core argument here is that cybersecurity isn't just a technical requirement, it's the indispensable enabler of trust, because without trust, financial inclusion cannot be sustained, just like I hinted earlier. So what does this mean? We now talk about key cybersecurity challenges. Yeah, key cybersecurity challenges. Now, the first one on that list there is digital and financial literacy gap. So there is susceptibility to social engineering, right? So these fintech users who are not financially literate, who are not digitally aware, they are susceptible to what? Social engineering, which is meaning somebody trying to exploit their vulnerability in terms of financial services and digital awareness to rip them off their funds. So it can be through phishing attacks by emails that are, that are suspicious, or scam calls. We know, of course, in Nigeria, for example, even here in the UK and other parts of the world, it's everywhere. Somebody can just call you and try to trick a user into providing their PIN or their OTP just in the bid of trying to help them resolve their account issues and all that. And then once those details are provided, it's gone. It could be even their card, the loan card number or the CVV at the back. Even here in the UK, somebody can just call you and tell you, oh, that your account is about to be compromised and they've created a new account for you. They pose like a bank, really. And then they want to help you secure your funds. So they've created a new account for you and they want to move the funds in your current bank to the new account, but they need authorization and they need you to provide some details before it's too late. Do this now. And before you know it, out of panic and out of, not being aware, these users who are vulnerable will just provide details, and then before you know, the funds are moved to the account created by the fraudsters, and then it's all history. The rest will be history. So this is where we're talking about digital literacy and the financial literacy gap that's is posed by the advent of fintech. And now we talk about data security and privacy breaches. This is another key cybersecurity threat when it comes to fintech. So risk of identity theft, financial ruin is also possible because fintech collect vast amount of data, and the risk is very, very high in this area. So a data breach is not just an inconvenience. It can lead to identity theft, yeah, and financial ruin for customers. And this can severely erode trust. So once there's a breach in data, it's a big problem. In some European contexts, for example, open banking has enabled regulations like the PSD2, right? And why this is a revolution, it brings about some revolution in the banking industry. It means that fintech are interconnected, yeah, and they share customer data. So a single vulnerability, for example, in one linked device could expose millions of customers' records, in the whole of the European Union, for example. So what this means is that because there is open banking now, open banking is a way whereby banks share information either with fintech or other maybe e-commerce companies or whatever. They share information with them. When they do this, let's use a fintech, for example. If the fintech taps into the security infrastructure of a mainstream bank, maybe they are partnering with them in some way, and then there is a breach in any of them, whether from the fintech or from anywhere, it will cause what they call systemic risk in that system. So both the customers of the fintech and even the bank, the brick and mortar bank, which they are trying to partner in that sense through sharing of information, either through open banking or any other information sharing method, it poses a lot of risk, and it can, affect all of the users of both the two institutions we're talking about. So in the EU context, open banking means you can share across the whole EU. So you can imagine when something like that happens in Spain, in Germany, in France, because of open banking, people can really interact in the financial sense as if it's a small village. Any breach in any of those infrastructure in terms of data leakage can be very, very disastrous at a very, very high scale. So that is the threat there. The next one is inadequate infrastructure and regulation. So many emerging markets simply lack sophisticated national cybersecurity infrastructure, so or skill talent, if you like. And then, of course, the lack of robust regulatory frameworks, yeah, to effectively defend against globally coordinated and highly sophisticated cyber threat. So some countries are still at the incubation stage in terms of this. In the UK, there are lots of government gateways where you can easily key into, and it's very robust and strong. And then that can help to ensure compliance and of the regulation is stronger. But in some countries, it's very weak. And then because of this, it can expose. Like when you talk about maybe your national, talked about national, the NIN, when they want to make the NIN like a kind of digital ID for people, you see your chip. It's like your NIN can help you do transaction. It's like a digital identity anywhere. In Nigeria, most people are still skeptical about some things like that because they don't even trust that the government's system is robust enough to be able to collect all of this data and put them all in one national ID card like that. And then if anything happens, that means they're gone. They can just, it's finished. So that's what we're talking about. That strong infrastructure to create that kind of confidence is always a problem. Having discussed the key security challenges, cybersecurity challenges for fintech, I want to now move on to how cybersecurity can be used as a tool for inclusion. So cybersecurity is an investment, just to be clear, in trust, and it expands fintech's market. It's not an option, it's an investment in trust, and it expands the reach or the ability of what fintech can achieve. So it is crucial to shift our perspective to understand that cybersecurity is not just a cost or a barrier, it's a powerful tool for enabling and expanding inclusion. By building robust security, we build trust, and that trust attracts more users to digital services. Now, some of the ways that cybersecurity can come in as a tool for inclusion is in the area of biometric authentication. Yeah, now this is a very good example because instead of complex passwords which can be forgotten or difficult for less literate users, to remember, we talk about using things like fingerprint, facial recognition, or voice recognition. And these ones offer even a more secure and user-friendly login access to these users. So this makes the service more accessible and trusted for those who struggle with traditional password management. So you can understand that most times, even the younger generation, we struggle with password. So let alone somebody who is not that financially literate or digitally literate, or not, the cognitive ability is not as high because of their social status. So having to remember long password and pins and all that can be cumbersome for them, and it can be a barrier. But with cybersecurity coming in, we have things like biometrics. They can just use their fingerprints. It's easy peasy. Everybody's happy. The face can also go as a facial recognition. Even the voice can also apply. So this makes it makes the effort of fintech in driving inclusion, much more feasible and easy to reach the right target audience. Another one we're talking about is AI-powered fraud detection. So using artificial intelligence and machine learning, fintechs can analyze transaction patterns in real time. If an unusual or suspicious activity occurs, the system sends a flag instantly, and that potentially stops the fraud before it happens. So these directly apply or protect rather users who have hard-earned money and had hard-earned savings stored in the bank or fintech company, and it fosters confidence in the safety of their digital wallets, as the case may be. For example, there was a time when I came to the UK here, I have an account with Barclays Bank. It's a big bank, a traditional bank, of course, not a fintech, a traditional bank. But now you see that even traditional banks too are also trying to incorporate some aspect of fintech in their services, because they know that if they don't align, they're going to be, they're going to be shipped out. So that you ship in or you ship out. So you see banks trying to really evolve, trying to do a lot of things with their app, trying to offer services that are bespoke, trying to, give the fintech companies a run for their money. In some cases, when they're not able to do so, what they do is they partner. They form that partnership or look for a very good fintech and partner with them, and then they begin to share infrastructure, data, clients, and of course product and services together, just for them to stay relevant. Because in the world of business, if you don't ship in, you ship out, and that is as easy as it sounds. So when I had a bank, my account with Barclays, then I used to make transactions that were not too high, because then I was actually a student, so I wasn't really earning so much, but maybe in the range of £100, £200, thereabout, £300 max. But the very first time I made a transaction of about £1,500, it didn't go through. He left my account. He left my. I mean, it says successful from my end, but the bank had some, AI machine learning algorithms, that's the word, in place to spot that change, that sudden sharp rise in my transaction pattern. And so they stopped that payment from their end, and someone had to ring me over the phone and was like, you made this payment, we want to get more details about the payment. Who is the payment going to? Why are you making the payment? Are you under pressure from anybody? Stuff like that. They were trying to gather questions to be sure that I actually made that payment and the payment was genuine and I was not under any pressure by any scammer or any fraudster to do anything. And the moment I give them my go ahead, that was when they allowed that payment to go through. So that's what we mean by how cybersecurity is helping to monitor transaction patterns of users to at least form that protection layer for these vulnerable users, especially. Remember, I'm talking about fintech here, and that is very useful. Also, I remember I was also working with Press Direct. It's a digital arm of one of the big international banks we know as HSBC, Hong Kong, I think Hong Kong and Singapore Banking Corporation. Yeah. So when I was working with them there, I had a customer there who also somebody called her, a fraudster did call her and was posing like a daughter who was in distress. So she asked, the fraudster asked the customer, a woman, to send her, an elderly woman really, to send some money that she's stranded. She needed some money and all that. And the woman, out of panic and care and love for her daughter, really using the daughter's phone and all, but it was more like an identity theft kind of thing. And he succeeded, and the woman sent 2 lots of payment to her. I think one was about 1,200, and that was about £820 thereabouts. 2 different payments within the same period. And it was later the woman now, after the call, the woman now called her daughter just to know how she's fine. The daughter was like, I didn't call you for anything. Who did you send money to? They said, no, somebody called me. You called me, saying you needed money. I'm only calling to check up on you to know if you're fine and all that. And that was when they knew that they'd been scammed. But thankfully, the money didn't go through because the account that the fraudsters provided was a new account. And because there's a system in place that when you like an algorithm, like I said, machine learning and AI in place, that when such payments come through, if it's a new payment, if it's a first-time payment, you've not made any payment to this person before, this person is not registered as a beneficiary on your account, and you're making a first-time payment of this amount to them, the algorithms or the controls in place says stop it, check it, and verify. And that was what helped the customer at the time. So the woman called me and was panicking that she's lost money. How can we help her and all that? And thankfully, I called the fraud team. and they said they've not allowed that payment go through because it was a first-time beneficiary and a first-time payment to that account. So they had to stop it, and they were planning to contact the customer. The customer was really happy. So, oh, thank you so much. An elderly person. So this is what we mean by cybersecurity trying to help. If there are no measures like that in place, after all, the woman made the payment herself from a mobile app. Nobody compelled her. But this measure made it possible that it was stopped, and then the money was refunded to her. So this is what we're talking about. Then we talk about secure digital identity. So you can imagine a universally recognized, a world where secure digital ID is available for every citizen. So this allows the unbanked to complete know your customer processes or checks remotely and securely. And this is a critical step for accessing formal financial services like opening an account or getting a loan. So this secure ID helps to remove barrier of needing physical documents or in-person verification at any point in time. So this is what we mean by secure ID. It helps the unbanked to really complete KYC processes in a fast, seamless way without having to leave their homes or leave their businesses, because that's what we call opportunity cost. The time you leave your business to go stand in a queue in a bank is money you are losing. It could be that you have to lock your shop up or your business up just to be in that bank for 1 hour, 2 hours, 3 hours to open an account. So that is opportunity cost in from economics point of view. But with fintech and the future of cybersecurity that has strong measures in place to really verify you, the biometrics and all that, your facial ID, your fingerprint, your ID card, they can snap it. If it has NFC feature, then it even makes it stronger. All of that helps to ensure that people can really go through KYC processes and without having to lose so much for it. So having discussed that, we move to the next bit now, which is the fourth section, and that is the synergy. We're talking about designing products for inclusive security. So the takeaway here is paramount. It's paramount. So we need to embed security from the very start of product development if we are to achieve our goal in terms of synergizing cybersecurity and fintech to promote financial inclusion. We need to embed security from the very start of product development. And this is what we call security by design. Security by design. So at that point of designing the product, we have to bear in mind security. Now, in view of this, then, what are some core things we can consider? There are some principles for inclusive security design we want to talk about. So when we talk about designing for inclusive security, what does that actually mean? It involves several key principles, but we'll talk about 3 of them. One is simplicity. So user interfaces should be intuitive and straightforward. It should minimize complex input. It should reduce the cognitive load or requirement for new digital users, because mind you, we've said these ones are not that digitally, most of them are not digitally literate. So we don't want to burden them with too many need to remember password, security authentication and all that. It should be simple and easy to use. So I think about a mobile money app using large, clear buttons and simple language to communicate, even perhaps in local dialect to communicate to these customers. This will help them complete essential, key transactions rather than, bringing up complex menus and too many layers of steps for them to complete a simple transaction. So this is what we're talking about. It has to embed that simplicity in the design of this product. I also worked on something like that too at some point when I was working as a product lead, with a credit union in here in the UK. I led that product, and I was able to redesign the website in such a way that it is clear, it communicates clearly. Remember, I said inclusion has to be responsible. Financial inclusion has to be responsible. So the website at the time wasn't too clear. The communication was cumbersome. People, when they go online to apply, because it's a credit union. Credit union is more like what we call a cooperative in Nigeria. It's targeting those who are largely marginalized, or maybe a small microfinance bank. So it has to be clear and simple. But the website wasn't doing that. So people, when they apply for loans, they're always getting declined because communication wasn't straightforward, and they are making wrong conclusions or assumptions from what they're able to read. And so they can end up applying for a loan they're not even able to pay for, because they're not able to understand the information. So we have to redesign that website, and in line with what we call the consumer duty, as expected by the Financial Conduct Authority in the UK, we had to tailor it everything, bring that to the website, redesign everything, align products in the way they should be, make it simple, clearly state what is required for each loan product, and everybody was able to, key in. And before you know it, the loan product, we're able to loan out more money and make more profit as well, while also serving the customers at affordable rate. So transparency is the next one. Users should understand why a security measure is in place. So clearly, they should explain security steps like an OTP, a one-time password. This should help to build understanding and trust. So when banks want to communicate things like OTP or security measures like fintech, it should be clear and simple. We can maybe send a message and say, we sent an OTP to your phone to protect your account. Maybe they want to make a payment or want to log in. The communication should be clear. It should be like, we sent an OTP to your phone to protect your account. They know, oh, you're trying to help me. That's cool. Instead of just saying, enter OTP. They put their password, you just put enter OTP. They don't even know what is that. What is OTP? They don't know. Why am I needing to enter OTP? They don't know. So we want to be clear, transparent in those communication when we are trying to target those who are financially excluded. And then we talk about resilience. Resilience is about systems that needs to be built to withstand attacks without a complete breakdown. So this ensures that this ensures the availability aspect of the CIA triad we mentioned earlier. So it utilizes cloud-based infrastructure, for instance, distribute services so that a localized cyber attack does not bring down an entire payment system. So people use cloud services just to ensure that the data is in places where people cannot access, instead of gathering all your data into one IT room and hard drive and install them in that room. Once an attack is made on that room, it's gone. But if it's in the cloud services, then you're always agile. You can always pick up, even if anything happens, your data is stored safely somewhere. You can easily pick up and run the business from there, and also data is not compromised. So these are the principles that can be included when designing fintech products with the aim of achieving financial inclusion goals. So we are almost coming to the end gradually now. We want to now talk about recommendations based on what we've discussed so far. So now let's summarize some actionable solutions and recommendations to address this risk. For the risk of low digital literacy and social engineering, which we mentioned earlier, the most impactful solution is massive digital financial education. So fintech companies, in collaboration with governments, NGOs, and community leaders, must run targeted local campaigns, both in person and through the mass media, to educate users on how to spot and avoid scams. This empowers users to be the first line of defense. The second point here is for the lack of risk, for the risk of lack of regulatory clarity or certainty. Here, governments and regulators should do what? Such as maybe central banks of different countries, the FC and all that, should implement what we call regulatory sandboxes. So these sandboxes are controlled, supervised environments where fintechs can go and test new innovations or products safely within a limited number of users, and set clear boundaries on how it's going to operate before launching into the market fully. So that kind of reduces the risk profile or the possibility of failure, which can incur large losses, or significant detrimental consequences on the financially excluded ones they're trying to target. So this fosters innovation while also safeguarding customers in a nutshell. The third one is for the risk that has to do with systemic risk from interconnectedness, right? Financial ecosystems can become more intertwined. We need to solve that problem by mandating interoperability and shared security standards. So fintechs and traditional banks must collaborate on common, robust security protocols for things like application programming interfaces, APIs, and data sharing. So this ensures that security is consistent across the entire ecosystem, protecting everyone and not just individual companies in isolation. So, having said that, in conclusion, fintech has indeed democratized financial access. It has brought services to millions that were previously excluded. However, the true lasting benefit of this revolution will only be realized if the digital environment is profoundly secure and trustworthy. So what does this mean for us? It simply implies that, first of all, there should be the synergy. There should be a synergy between cyber security and fintech. It's essential for sustainable financial inclusion. Secondly, trust is paramount. Without it, any inclusion effort will always continue to fail. So trust is paramount. And what is the future focus? The future focus is such that we need to design products that meet three key things. They have to be accessible, that is reaching the unbanked. It has to be affordable, that is serving low-income populations, and it has to be secure. And by that, we mean security by design. It should be built with the highest standards of protection and resilience against cyber threats. What is our goal? The overall goal here is to foster a digital ecosystem where individuals, regardless of their location or background, can transact and save with confidence and trust. So if we put all of this together, we will be able to see and actually actualize our potential or the prospect of fully synergizing cybersecurity and fintech to achieve global financial inclusion. Thank you for your time and thank you for listening.